Imagine waking up to find that Bitcoin, recently at its all-time high, has suddenly slipped by 6% in just over a week. The headlines are screaming, traders are panicking, social media is ablaze. But beneath the chaos, the real question echoes. Are the shadowy movements of Bitcoin's biggest holders, the so-called whales, warning us about a coming storm, or is this just another typical shakeout before the next big surge? If you've ever watched Bitcoin break records, then nosedive without warning, you know this feeling. One moment, optimism and euphoria. The next, anxiety and confusion. But what if history, hidden indicators, and a few powerful players could help us predict what comes next? Today, we're diving deep into the latest Bitcoin drama, the good, the bad, and the absolutely nerve-wracking. To understand what's at stake, let's rewind. Bitcoin, once a niche digital experiment, is now a trillion-dollar colossus at the center of global finance. In the last decade, it's minted millionaires, fueled industry booms, and terrified regulators. Its price moves not just with news or hype, but with tides of capital, the invisible tug-of-war between buyers and sellers, bulls and bears, hope and fear. Bitcoin's wild volatility is legendary. When the price surges, everyone wants in, only to crash back down as fast-moving funds exit the stage. Underneath it all, the whales swim, addresses holding vast amounts of BTC, often moving quietly but wielding incredible power. When whales act, the waves ripple through the entire market. In recent years, whale watching has become as popular among serious traders as technical analysis or on-chain forensics. Why? Because these large holders can make or break market momentum. Glassnode data recently revealed a fascinating phenomenon. Since late 2024, addresses holding over 100 BTC have exploded by nearly 14%, hitting around 18,200, a level unseen since Bitcoin's epic 2017 rally. This is not just a fun fact. It's a chilling echo of past market cycles, where a spike in large holders often foreshadowed a major climax, sometimes followed by gut-wrenching corrections. Remember 2017? Euphoria reigned, whales accumulated, and then the market toppled, wiping out fortunes in weeks. As Bitcoin soared to a new all-time high above $113,000 this spring, bulls cheered, but the celebration was short-lived. Over the past 8 days alone, Bitcoin slid 6%, settling above $104,500 and, critically, testing the nerves of long-term holders and new entrants alike. Is this just a routine correction, or is something bigger brewing? Let's look at the technicals. The Ichimoku cloud, a favorite of chartists for its predictive power, now casts a bearish shadow. Bitcoin's price is stuck below the cloud's boundaries, a red zone that warns of negative momentum. The Tenkan-sen and Kijun-sen, key short-term and medium-term moving averages, are both angled sharply down. Even the Chiku span, the lagging line, lingers beneath the price and cloud, reinforcing that bullish faith is at a low ebb. And then there's the looming threat of a death cross, where short-term moving averages plunge below longer-term ones. Historically, this has often preceded sharp corrections, sometimes double-digit gut-punching moves down. Right now, with Bitcoin hovering just above key support at $104,584, the stakes are sky-high. Should this level shatter, analysts warn the next stops could be $102,135, $100,694, or even as low as $97,000 or $92,000, a flashback to previous deep dives. But every dark forecast has a hopeful counterpoint. If the bulls regroup and retake $106,726, or, more powerfully, push above $110,000, the death cross scenario is likely to be invalidated and new highs could beckon. The battle lines are drawn, but uncertainty reigns. Stepping back, Bitcoin's story is now about more than price charts. It's about signals and psychology. Technical indicators like the MVRV Z-score, a favorite among analysts, have again flashed warnings. When this metric climbs too high, it means Bitcoin is trading far above its historical cost basis, a classic sign of overheating markets. Marie Poteryayeva from Glassnode notes, "The MVRV Z-score has reliably signaled when Bitcoin is close to a peak. Right now, it's sending clear caution signals." Volume tells another story. As Bitcoin attempted to rally in recent weeks, trading volumes actually faded, a divergence that often hints at a weakening rally when fewer buyers are willing to chase ever higher prices. Add in the Pi cycle top indicator, which tracks the relationship between key moving averages, and the warnings multiply. Its crossing pattern has preceded several previous market tops. Even seasoned experts like Justin Bennett are sounding alarms. If $106,000 breaks, we could see a double-digit correction, Bennett cautions, outlining next stops at $101,000, $100,000, and even $92,000. Yet he's quick to add, a daily close above $110,000 wipes away much of the downside risk. This level is the new battleground for bulls and bears. Why does all this technical chaos matter? Because in crypto, volatility is amplified by psychology, and psychology is steered by the moves of the largest players. Cole Garner, a veteran analyst, observes, market exit points are often dictated by whale behavior. Euphoria, whiplash, complacency, it's the same cycle repeating again and again. That brings us back to the whales. In the last week, after a sharp dip in whale addresses, there's been a slight uptick, suggesting some of the giants are quietly accumulating again. Could they be preparing for another rally, or are they lulling the market into complacency before the next drop? What's especially unnerving is the timing. Whale counts had just reached their highest since 2017, right before that infamous crash. Today's rebound in whale activity may look reassuring, but history urges caution. Whales can absorb volatility and support prices, or dump enormous holdings, sparking cascades of panic selling no retail trader can resist. Meanwhile, the macro backdrop is a pressure cooker. Inflation fears, interest rate jitters, and regulatory uncertainty swirl around crypto like a gathering storm. Each headline, each policy hint, has the power to accelerate or reverse Bitcoin's trends in an instant. For institutional investors and everyday traders alike, the sense of walking a tightrope above a chasm is palpable. It's not just about technical patterns. It's about a complex interplay of sentiment, liquidity, and coordination. As history shows, when too many people stand on one side of the boat, even a small wave can tip everything over. All eyes are on the critical $106,000 support. Bulls desperately defend, trying to turn back the bearish tide. Whales move quietly in the deep, possibly accumulating or waiting to strike. Meanwhile, average investors are left guessing, glued to charts, hoping this isn't the calm before the next storm. So, what happens if the $106,000 threshold gives way? Are we facing a healthy correction, or the spark that detonates a larger collapse? And what about the whales? Are they really supporting the market, or quietly preparing for a major exit? The battle for Bitcoin's future is entering a high-stakes phase, and the next moves could define the entire crypto cycle. What, or who, will tip the scales? And could you spot the clues before the rest of the market wakes up? So, with all these indicators and expert warnings swirling around Bitcoin, where do we go from here? Are we truly on the brink of a sharp correction that could rattle the entire crypto market? Or is this just another temporary wobble before the bulls step in and push prices to new all-time highs? The stakes could not be higher, and what happens in the next few days may shape the Bitcoin narrative for months to come. Let's break down the possible futures that could unfold in the wake of recent events, and what those mean for investors, traders, and crypto enthusiasts worldwide. First, let's examine the downside scenario, the possibility that whales and technical levels trigger a deep correction. Several technical signals are sounding the alarm. The Ichimoku cloud, a favorite for visualizing momentum and trend direction, is painted red ahead, suggesting bearish bias for the near future. Bitcoin's price is now hovering just above the crucial $106,000 support, and the infamous death cross, where the short-term moving average falls below a long-term one, has either just appeared or is dangerously close to forming once more. According to respected analyst Justin Bennett, if $106,000 fails to hold, it could unleash a cascade of sell orders, pushing Bitcoin down to $101,000, $100,000, or even lower, with the next significant floor possibly around $97,000 and in dire scenarios $92,000. But what could be the domino effect if this bearish scenario plays out? A sharp plunge below key levels would not only inflict pain on leveraged traders, but could also shake long-term holders' confidence, at least temporarily. We could see heightened volatility, with altcoins also selling off, and investor sentiment turning fearful. It's the kind of environment where fear, uncertainty, and doubt, what the industry dubs FUD, can dominate headlines and social media, exacerbating any downward move. Now let's not forget the whales. Their actions are often invisible to most retail traders until it's too late. A continued or renewed decline in whale addresses might signal profit-taking or distribution, often just ahead of major corrections. Yet, a stabilization or rebound, as we've observed recently, could be evidence of strategic accumulation, positioning for the next big move. So, is there any light at the end of the tunnel? Absolutely. The bullish scenario remains very much on the table, hinging on Bitcoin's ability to defend $106,000 and regain lost ground quickly. If the bulls manage to push the price above $110,000 and hold it on the daily chart, this could invalidate the bearish outlook entirely. In the words of Justin Bennett, such a move would negate any move lower, making way for a fresh assault on previous all-time highs and perhaps far beyond, potentially $112,000 or higher in a renewed rally. Another analytical lens comes from Glassnode's Marie Poteryayeva, who highlights the MVRVZ score, an on-chain metric that compares Bitcoin's market value to its realized value. When this indicator hits extremes, it often signals market tops. Right now, the MVRVZ is flashing warnings that we're entering overheated territory, historically preceding corrections. Similarly, the Pi cycle top indicator, a crossover of key moving averages, suggests that the current trend might be approaching exhaustion, another cautionary sign. But here's the twist. History does not repeat itself perfectly. In previous market cycles, whale accumulation near the top sometimes preceded a final euphoric surge, a last hurrah before the plunge. With the number of addresses holding over 100 BTC swelling to levels unseen since 2017, it's possible that big players are bracing for volatility but also see opportunity in accumulating while others panic. Cole Garner, a respected on-chain analyst, offers a practical rule of thumb. Consider the 15% rule. According to Garner, when Bitcoin retreats about 15% from its all-time high, it often marks a period where heavyweight whales begin to seriously manage their exits. The pattern transcends crypto. This 15% drawdown is a universal marker of shifting market tides, says Garner. In other words, institutional investors and whales watch these levels and act accordingly, offering us a rare glimpse into the psychology of smart money. So what does this all add up to for the average investor or trader? The next few days could see one of three major scenarios. First, a breakdown below $106,000 could trigger a rapid correction, with possible flash crashes as sell stops are hit and panic spreads. Second, a rebound above $110,000 could reignite the bull market, drawing in both sidelined retail traders and institutions looking for momentum. Third, and sometimes forgotten in the drama, is a period of consolidation, where Bitcoin trades within a tight range, digesting recent gains and losses, and waiting for the next macro catalyst to define its direction. But how can you, as a viewer and participant in the crypto market, make sense of this maelstrom? Let's talk practical strategies. What can you do now to protect yourself and even potentially profit from the volatility ahead? First and foremost, always know your risk tolerance. Volatility in crypto is not a bug, it's a feature. Yet it's the same volatility that creates millionaires and wipes out fortunes overnight. If you're overexposed, whether that's through using leverage or having too much of your portfolio in Bitcoin or altcoins, now is the time to reassess your position. Setting stop losses is more than a technical habit. It's a discipline that preserves capital in bear markets and lets you play another day. Second, keep an eye on key support and resistance levels. Right now, $106,000 is the critical battleground. A sustained break below could be your cue to de-risk or consider short-term hedges. Conversely, if you see Bitcoin reclaim $110,000 with conviction, supported by healthy trading volumes, that might be the signal to re-enter or build new positions. Remember, whale behavior can foreshadow big moves. Pay attention not just to price but to on-chain data. Are major holders accumulating or distributing? Third, diversify your sources of information. Don't rely on just one indicator or social media narrative. Fundamental developments, like regulatory news, institutional adoption, or even macroeconomic events, can override technical signals in the blink of an eye. Savvy investors monitor both charts and headlines, seeking confluence before making bold moves. Fourth, learn from history, but don't be handcuffed by it. As the Glassnode report and past cycles show, indicators like the MVRVZ score and Pi cycle top are never perfect. They tell you when the market may be overheating but can't predict the precise top or bottom. Use them as warning signals, not as gospel truth. And here's one of the most underappreciated strategies. Consider dollar cost averaging. If you're here for the long run, the day-to-day swings matter far less than the overall upward trajectory over years. Buy small amounts regularly, especially during periods of panic or deep corrections. Some of the most successful Bitcoin holders are those who simply outlast the noise, stacking sats, ignoring the hype, and letting time do the heavy lifting. Now let's touch on a secret fact that few talk about. Many of the most explosive Bitcoin rallies in history have followed periods of extreme fear and capitulation. When it looks like all hope is lost, when headlines scream that Bitcoin is finished, whales are dumping, and technicals are broken, that's often when the seeds of the next bull run are quietly being planted. The biggest players in the market thrive on volatility, not stability. Sometimes that sharp correction everyone fears is just the final shakeout before the next leg up. In conclusion, are whales and technical levels about to unleash a correction, or will renewed accumulation spark the next rally? The answer is both reassuring and unsettling. The market stands at a knife's edge. A break below $106,000 may spell deeper losses in the short term, but renewed whale accumulation and on-chain signals hint at underlying confidence among big players. The next all-time high could be closer than it appears, but only after the market has tested the nerve and the conviction of its participants. So what should you do now? Stay alert, monitor the charts, and above all, manage your risk. Don't let panic or euphoria dictate your decisions. Remember, the Bitcoin story is far from over. Volatility is the price of admission for being early in a technological revolution. If you found this analysis valuable, hit the like button and subscribe for more in-depth crypto research and market psychology. Share your thoughts in the comments. Are you bracing for a correction, stacking more sats, or simply watching from the sidelines? And if you want to catch that secret fact about Bitcoin cycles and what smart money is doing behind the scenes, follow our channel. We'll be tracking every twist and turn. Thanks for watching, and remember,